Right now, the market seems to be completely ignoring.
We're not seeing that happen.
Because I'm known to kind of look at data. I mean, I would own this property any day.
Now, I saw some of this coming.
It just makes zero sense.
Awesome. Welcome, Neal Bawa. We've got from Grow Capitus. Welcome, Neal.
Thanks for having me.
Great to have you. Well, I'm excited to be here, and I'm excited that you're all here. But I'm going to set the table for what tonight's going to be about. It is the 2023 Multifamily Outlook event. We're seeing rates continuing to rise. It's getting harder to get multifamily deals done. I had a conversation with Neal previously, and he said multifamily sales volume is down 78% from 12 months ago, right? So there's a lot of questions as an investor. And if you're on this, you're watching this, you're interested, should I be investing right now? Should I be holding cash? Are my investments in multifamily safe? What should I be looking at? What's the Fed going to do? We're going to jump into all of this. So get ready, buckle up, let's go for it. So to get started, we're going to start with Ken. So Ken, give us a quick layout as far as what you see in 2023. What's kind of a high level overview of what investors should be aware of that are getting into or already invested in multifamily?
Sure. So we as a group underwrote hundreds of deals in 2022. We made offers on 50. And we were in probably 45 best in finals, and we ended up with 2. And, obviously we could have stretched and we're in very specific markets. So there's a lot of competition in those markets. And I think there's a big difference between the seller and the buyer, obviously still. So the buyer is obviously looking out the windshield, and the seller's looking in the rearview mirror. But it's a game of chicken, and the seller's going to lose. So what's going to happen is the buyer is going to continue to underwrite at the current debt rates that we have, whatever they are. I do think they're going to continue to go up, at least in the first quarter, to try to tamper some inflation. I'd like to hear Neal's piece on that. But there's lag. There's lag between the bid and the ask with the seller. Totally fine. I'm okay with that. I went through this in 05, 6, 7, 8, 9. Whether it was from a syndicator or an owner that already had a seasoned partnership or a bank, it didn't really matter. You just got to stick with the fundamentals, cash flow. That's it, and just be diligent on whatever your underwriting box is. Just stay there. Don't worry about anything else. So I think 2023 is going to be a time of getting your liquidity together. And I'm focusing on operations. So, candidly, during this run, my own management company, the one I own, it's got 300 people in it. I think we got a little soft. We got soft on all kinds of stuff, on expenses and things that we could do better. So I've been focused on that right now. While even though we're offering every single week on stuff, I'm kind of focused on operations.
Awesome. Thanks, Ken. That's a good, kind of summary. I want you to come back to lag, because I think that's a really interesting concept. Later, we'll talk about that in a bit. Neal, what do you want to add to that? What are you seeing 2023? What should investors be aware of, or what do you see happening in multifamily?
What we've already seen, we might see a little bit more than that in Q2, because what's happening is that people have made so much money, people have made so much in profits, that they're not willing to accept the fact that they might have to sell their property at a loss. They're either putting money in for themselves at this point of time, stealing money from their operating reserves and getting those down to zero. Maybe they'll do a small cash call for their investors. None of those phases have really happened for sufficiently large number of units for brokers to start saying, hey, this market is problematic and you need to lower your price significantly. And so that's where we are, where the biggest number in my mind is the one that you already said, Bronson. Volume's down 78%. Nobody wants to sell their building if they don't have to, because everyone thinks a year from now they're going to be in a better situation. And so we are at a log jam, and I'm not seeing it get resolved in Q1 or Q2.
Thanks, Neal. Mark, why don't you share a little bit of your thoughts? I'd also love for you to touch base on the lending environment, because I know that's a big factor as well. So maybe you can take some time and just talk about 2023, what you're seeing, and as well as kind of what's changed in lending.
Yeah, no, both Ken and Neal, great points. I guess a couple of things back to what Neal had said, I would agree as far as the disconnect, and Ken brought up as well between buyers and sellers. But I'm also getting, this didn't happen just this year, towards the tail end of last year, number of deals, a lot of people aren't well capitalized. So while they mentioned, Neal said, hey, they're going to go try to do capital call, hopefully you don't have to do that, but people are going to be like, I'm not throwing, good money at bad. So they're going to be tough there. A lot of the syndicators aren't well capitalized. They can't put money in themselves. So they're going to be sitting there staring, going, what do? We sell at a loss or sell if we can get break even. A lot of these cases, it's a win in some of these deals if you could break even, but you're not going to break even in some of the deals. So I'm already seeing deals brought to me. People are like, sell them at the loan, whatever the loan value is, pay off the loan. It's limited for sure, but we're going to see more and more of that, especially when the rate caps, not cap rates, but rate caps, just think of it as insurance protection against the rate. When those wear off, which they are, on a lot of cases, and bridge debt becomes due and things like that, we're going to see a lot more deals that are distressed, maybe not operationally distressed, but they don't have the money to survive. So in some cases, it's simply, I know investors are sitting there going, well, we were used to making all these returns, like to Neal's point. That's not just the syndicators, that's the investors too. And they're going to have to readjust their expectations. Distributions are going to be light and maybe non-existent in some deals. And, if the general partners, syndicators aren't coming back to you asking for money, be thankful. I've never done it yet on any deals, period. And not to say we have put money in our own deals, because we have, but never going back to investors and taking money from them for a capital call yet, and hopefully never have to do that. But a lot of people aren't in a position to do that. So you're going to see distressed deals coming in for sure. I think as far as deals coming out, Neal said, hey, people aren't going to sell unless they have to. There'll be some people that have to sell. Other people might say, well, you know what? There's still some equity there, so I'm willing to sell at a certain, profit, less than I would have a year ago, but I'm willing to do that, just take my chips off the table. I think anyone that has debt right now, back to the loan discussion, people that have debt becoming, due, or if they have a fixed rate debt, they're going to be people that are going to want to assume those loans. So a lot of loan assumptions. Refis are going to be there because people will be stuck with a refi because they can't make money on a sale. All of us that have been blessed not to have recourse debt, on our multifamily, there will be people, and already happened toward the tail end of last year, where people will be signing on recourse debt in order to go to like local banks. That's going to happen without a doubt. It's already happening. A lot of recapitalization. How do they do that? People are going to take advantage. Sharks are out, and they should be, because that's what they do, right? They're going to make money. They're going to be high interest rates. You need money for a deal, I'll put it in. It's going to be, 13 to 18%. I want part of the GP. Pick some numbers. I don't care what it is, but it's high. Put it that way. It's high. So people will be taking that. A lot of people buying new will try to look for fixed debt, whether that's bridge or Fannie Freddie, things like that. I would make sure you're getting, at least like a 5-year horizon, personal opinion, even if it's a bridge, so you at least have some runway there. There's going to be, rates as far as that. I don't know. I'm not going to project. I think, that the first half of the year, Ken brought up as well, probably going to be, a little bit tougher. I'm pretty convinced, at least by election year, the, consensus is meaningless in my mind. Nobody projected this was going to happen. The smartest people in the world didn't project this was going to happen the way it happened like this. But there's going to be some opportunities because of that. So making sure that you're, looking at fixed rate debt, making sure if you do bridge, you have rate caps in place no matter what, and you worked on your model. Ken brought it up, underwrite with the highest interest rates for the duration of the project. Hopefully they go down. But these lenders have to loan money. They can't sit there. They have returns they have to project back to their investors too. They can't not loan money. Banks make money by loaning money multiple times over and over again. They're going to have to loan. So there are already some shifts right now in the lending that we've seen, where some lenders have come back to us and said, well, you know what, we'll actually work with you on the rate a little bit, not drastically, but some. There are some that are doing their own rate caps internally. So you don't have to go out to the market and pay, hundreds of thousands, some cases millions of dollars for a rate cap. Some of them will keep it on their own balance sheet to give you as a fixed debt. So there's more options coming out, which are good, not perfect. And I wish it was better, better like it was before. But lenders know they have to loan money. I think as a investor and or as a syndicator, using lenders that are operators, in my mind, meaning operators, they run their own properties and things like that. Don't do that. My personal opinion, because they're the ones that can come over and kind of equity strip if they need to. Almost every loan right now, I don't care whose it is, it's high percentage. The way the loan docs are written, pretty much almost everyone they could probably call default. No matter what, you missed one day on your insurance, you're in default. You didn't send us your monthly reports on time, you're in default. So those operators that are also lenders, those are the ones that are going to try to potentially come after properties. A lot of the other lenders, they don't want the properties back, so they're going to be more apt to work with you. Sure.
Thanks, Mark. So I wanted to ask you, this is really that you brought up a lot of great points and a lot of great points on lending and a lot of, I wanted to just touch base and see, maybe go around to Ken and Neal. What do you see now as being the biggest deals that are at risk? Because again, if I have a deal with an operator, a lot of people are wondering, like, is my deal okay? Or what are the highest risk or lowest risk type of deals that you would see? Would it just simply be, maybe we start with Ken, would it just be more fixed rate debt is safe and stuff that's more variable and coming due, that's more higher risk? And what are good operators doing right now to kind of mitigate that? You talked about, operations. Can you talk a little bit more about some of those best practices?
Yeah. So we have 6 projects in construction. You don't get fixed rate construction debt. So, so when you start a construction project, let's say it's a $60 million, 40 debt, let's say, and 20 equity, you start, there's 2 problems. One is costs are higher. The second is cost of debt is higher. So those are things that have happened in the last year. So you got to watch, I think Mark talked about this. We have reserves both on the contingency side for construction, but also on the equity, in case of any interest rate issues. So I think that's a biggie for people, because there's no lenders that's going to fix on anything unless it's actually in service or, fully done. So anything that's under construction, I think, is at risk, potentially, because they started probably in the 3-4 range. Now they're in the 6-7 range. On 40 million, that's a lot. Let's say that's just one example. So that's one. Number 2, I would say value add, anything value add with bridge. So, and the people that didn't buy caps, there's a fair amount of those, believe it or not, people didn't buy caps. And, back a year ago, caps were a lot less. They priced a lot, and it's not unusual for a cap to be $1 million now. So, we're getting paid on our caps. So anything that was value add, and so you have low maturity issues or cap expirations or whatever you want to call them. Those are going to all be at risk. And I think anybody that doesn't have dry powder is going to be at risk. And I think, we're already hearing it. Mark's hearing it. I'm hearing it. I'm sure Neal's hearing it. People are going out and finding ways not to lose their projects or recapitalize them kind of behind the scenes. And I think as an LP, you have to be really careful to understand, if new money comes in, what does that mean for you? What does that mean for the GP? What does that mean for the existing LPs? And, is it before you, after you, dilute you, all that kind of stuff is going to be probably surfacing in 2023 would be my guess. I, like Mark, this is our 21st year in multifamily syndication. We've never cash called an investor. We've lost money before, back in 05, 06 on some condo conversion projects, so you become wise to, you don't learn anything when you're making money. You learn a lot when you lose it. And so, from our standpoint, we've been, putting stuff in place just because we don't want to have to go there again. And so I think there's going to be a lot of people that haven't been through this. 10 years, you could fog a mirror and buy a deal and you'd be good. And it's, nobody's really experienced what we're about ready to see. And so it's going to be interesting to watch.
Yeah, we're seeing it already. Some of the larger groups. Now, there's a group called Veritas, which works in San Francisco, and where Neal lives, and they've $450 million loan default. Just I think was posted this week. And then a group called Chet REIT, which is a developer, a $481 million loan over 43 properties. The first one was 62 properties, 43. Now, these are more higher end type of stuff. And of course, there's unique situations and stuff. But Neal, what are some of the risks that you're seeing right now in the market?
I think the biggest risk, ironically, I saw both of those articles come out this week. Not surprised. I think the biggest market risk is in the multifamily construction market in the syndication bucket. We think syndications, most of the US, the truth is syndication markets maybe 5% of the US multifamily market, maybe 10% now. But what happened was a lot of syndicators, as long as they're buying rate caps, they may not default on their property. As Ken said, they might bring in extra capital, and that new capital probably will come in with preferential treatment, but at least the property won't be lost. I still prefer that as the last case. I haven't done a cash call either. But I think what happened was in the 2018, 19, 20, 2021 timeframe, a bunch of syndicators the young syndicators that had access to money started doing development projects. And these folks are, pardon my French, fucked. They're screwed because we're seeing LTCs drop from 75 to 70 to 65 to 60 and now even to 55. Where are they going to bring that equity in? Now, I saw some of this coming. I went back to my investors and asked for a discretionary fund. I have it. It's 8 figures. It's at my discretion, right? So my investors, I don't have any PPMs saying you must put this money into this building or whatever. It's a discretionary fund that I can use to support my assets, or I can basically go out and give somebody one of these horsehead deals. I don't know if Ken knows the word horsehead. Essentially, it's where I go in and tell somebody, I'm going to take over your deal. I'll bring in the pref equity. Basically, all of your investors are going to be at the bottom level. If the property does really well, they might make their money back, but otherwise, it is what it is. And you basically take a wallet of $10 or $20 million and you walk around looking at people's deals. That's going to happen. I think it's going to happen the most with these development projects. I was seeing syndicators that had never built a property put $20 million into a 300 unit property. I just did a $69 million loan on a 300 unit property, but that was my 5th project. And I did it with the same bank that I'd done 4 with. And they were nice to me. We could have walked away and it would have been problematic for me. But if you're on your first project and you have a 300 unit loan coming up right now, they're going to ask you to put $10 million in. I think that segment of the market is going to implode in the next 6 months.
Yeah, I know I've always been concerned about development for that reason, just the time it takes to get those things to market. And of course, all the risk that goes with the financing, like you guys both mentioned. Question that I want to ask, I want to ask Ken this one. I want to go around. But you talk about lag and you talk about, you do some videos on this, but I think your videos are awesome. But talking about, the Fed is making moves as long as I know all of you have opinions on this. I want to hear all of your opinions. But rates are continuing to rise. If they're rising in a smaller amount, obviously that's better. But eventually it'll get to a place where we'll start to plateau. And then when will that happen? What will change in lending? And once things start coming down, all this money. It's been said. Bloomberg said Americans have a record amount, 4 times the amount of cash in savings, over $5 trillion just sitting there. So all this money on the sidelines. So I guess that's kind of a big question. But Ken, can you kind of just talk through what you see the Fed doing the next 6 to 12 months, how it's affecting multifamily, what's the lag effect?
Sure. Well, I did, we were at 9.1 inflation in June. We had the first rate increase in March of 2022. I believed that we were going to go through pretty aggressive, Powell was pretty clear on, now you don't always know, right? But he was pretty clear. And the Fed was doing their committee's approval was unanimous. So this wasn't contentious at the committee approval level. So I'm like, wow, they're really going to try to get this 9 down. So, that's what I was like, we're definitely going to get these rate caps. We're definitely going to do all this stuff. So I was, it was a guess, of course. And I still think that, we're going to see some pretty heady inflation this year, I believe. I don't think we're going to be under 4 for sure by the end of the year. I don't, but I could be wrong on that. So I do think that they're going to be doing 1/4 and 1/2 points in the next few meetings. And I don't think we've seen really unemployment, the real numbers. I know I was talking to a couple economists just in the last 30 days, and they're saying there's some big differences between what the BLM is saying and what, some of these household surveys are saying, upwards of even 1 million people. So I don't know what the truth is, but I do think that the top is off, and I see cap rates. We're not looking at really anything under 5 now. So that was very different. And, we're probably looking at 4 or 6 deals a week and maybe offering on 1 or 2. That's after a whole bunch more are vetted in the markets we're looking at. So, I do believe, and I think Mark said it, we're looking at fixed rate assumptions with more equity. I think one of the big issues that nobody's really addressing yet is also, if you are raising money at 5 or 6, let's say, equity, debt is higher now. So you now have a different, debt is less risky than equity. So it's an interesting thing that's happening right now where debt, in a lot of cases, not in every case, if somebody's raising 8 or 9%, then of course it's not true, but then the deal's not cash flowing for sure, and they're relying on a capital gain event in order to pay that. So it's an interesting time to see the difference between debt and equity. They're actually priced pretty close. So I haven't seen that in a long time.
Yeah, thanks. Thanks for sharing that. Mark, give us your thoughts on what you're seeing right now with the Fed. What do you have? I know not necessarily predictions, but how do you see this playing out the next 6 to 12 months? Just kind of an ideal situation.
Yeah, before I go there, just real quick too, because of the other question previously, I wanted to mention something that both Neal and Ken brought up, excellent points, but there's a third piece out there right now that's really impacting a lot of multifamily, and it's insurance. And I'm not just throwing it out there; it's substantial. In some of these areas where Ken's in Arizona, so insurance is cheap, right? We had, give you an example, this real example, $600,000 a year insurance was going to go to 3.6 million. There's no joke. That's a deal killer. Like, you're done. The deal's over.
Is that in Florida?
No, Texas, South.
Wow.
Texas, there's some deals, that was $500 a door per year or $2,100 a door per year. So the reason I'm bringing it up, it's a double whammy, right? Your interest rates are going through the roof, and then your insurance is, in some cases, going through the roof. And if it was just one or the other, maybe you could say, hey, we can survive and limp along. But if you get hit on a property with both those things substantially, you're screwed potentially. So I just wanted to bring that up. So be careful as an investor too, where you're investing. Understand it's drastically different across the country on insurance premiums. It doesn't even mean that something happened at a property or even in that area necessarily, but so just be leery of that. With the Fed, I think, frankly, the Fed doesn't know what they're doing. That's my personal opinion. I think, to Ken's point, the lag and things like that, I see, we had all these jobs added, and I hear every single freaking, company laying off people, banks and all the IT companies, but so somehow we have all these jobs being added. It makes zero sense whatsoever. They're not waiting to see what the impact is. I don't know how you can be this aggressive without at least seeing what the impact is going to be first. We've seen the impact, Neal said, multifamily is down, whatever it was 79% or whatever. We've seen people that don't want to borrow money anymore. People don't want to buy houses. So how that, there's a huge impact that's happening right now, and there's not enough time being put in to just decide. I think it's like they always do. They're going to do it till they break it to the point where it's totally broken. And then enough people, that actually can influence the Fed, you and I, have no impact on them, but there are people definitely that are influential. All the big wigs meeting this week, right? All the smart people that run the world. It will come to a halt at some point. And if it doesn't in 2023, I mentioned earlier, I'm pretty convinced, not projecting, pretty convinced in election year, it will start reverting, because they will get political pressure. They're not a political organization, right? But they're still people, and now I'm trying to be whatever. People have ways to make people do things, whether they have dirt on somebody. I mean, there's things will happen, but I don't know. I think there's not enough time, in between right now to see what happens. To Ken's point, I think they will continue to raise, not as aggressive. The advantage we have a little bit now is that we will be smarter investors. Ken said it, right? Going through this time, no one's ever seen it. You're going to underwrite at a little bit higher rate. But we had some deals that went up 350 basis points. So 3.5% while we're under contract. So, is that going to happen between that? I don't think so. I don't. And I'm pretty confident in saying that, but no one could have seen that coming. So as long as you underwrite, with a little bit higher rate, it's not going to go like I just mentioned. I don't think some examples from 2022, but there will be a lot less deals done for sure. And it will, like anything, right? Values, I'll put all the money I have that real estate's going up, 100% guaranteed. When? I don't know. Nobody else does either, but it'll go up. So you can survive in some cases. It's surviving. So as an investor, be sitting there going, when I'm getting my preferred return, let me pull the pro forma up. Those days are a little bit over on some deals for some period of time. So you need to be sit tight, be patient, and realize that some of these returns aren't going to happen in the immediate. Maybe eventually, you hold it long enough, eventually it'll go up. So.
Yeah, I think it's a really interesting time in multifamily. I think my opinion is a little different than a lot of people, in that I think we'll look back on this time and really look back and say, man, I wish I had found a way to own a lot more stuff, because I think that what's going to happen, whether it's 3 months, 6 months, 12 months, 2 years, whatever that time is to where rates start dropping, I think that there's going to be all this money that's going to flood in. And I think it's going to be very interesting. And I also think the Fed, they stay one course, they stay what they're going to do, and then all of a sudden they can quickly shift. Oh, actually, we're doing this now. They kind of like stay the course and they switch. So we don't know when that will happen, but it happens very suddenly, like it did when they say, "Oh, now we're raising rates." So it's interesting to see. Neal, talk to us about the bipolar market. We had a conversation recently, and you were talking about how this is the most bipolar economy and market situation, and the Fed. And can you talk more about that bipolar kind of dynamic that's going on?
Yeah, sure. Obviously, Mark did a very good job of sort of summarizing the challenges. So about that side of our economy, right? But then on the other side, we have this bizarre situation where the Fed started 12 months ago pounding the crap out of the economy with the fastest interest rate hikes of all time. 11 months ago, unemployment was 3.5%. Today, it's 3.5%. Now, let's assume Mark's right, and there's a fudge of 1 million. That puts it at 3.8. That's bipolar. This economy is fighting the Fed in a way that previous economies have not. The economy in 1982 didn't fight the Fed this hard. When interest rates were being raised in 2015, 16, 17, 18, activity was coming down. Right now, the market seems to be completely ignoring the Fed. And so we've got this extraordinarily bizarre bipolar situation. I have some guesses, and I actually don't have data to support this, and I hate saying that because I'm known to kind of look at data. But what I'm seeing is, I think what's happening in the marketplace is that there are other countries that are in so much worse scenario. The UK dead in the water. The Eurozone is in horrible trouble. China, if you don't know what's going on in China, you have to study it. This is dead man walking. And when you look at what's happening there, we look a lot better. So we continue to get institutional capital come into not just real estate, but everything overall across the board. I see inflows. They're very strong. the dollar is much stronger than it was 24 months ago. So it's come down a bit, but it's still very strong. So when you look at all of those things, the fundamental economy is very strong. You said household balance sheets are so strong. I mean, they're ridiculously strong. We helicoptered $4 trillion into people's homes, right? And the last time, 2008, we gave money to the banks. We gave money to General Motors. This time we gave money to people and they're spending it. They haven't spent all of it, and there's still trillions of dollars in their bank account that they didn't have the day before COVID. So you've got this fundamental economy that is very strong. And if anyone doubts it, I go back to this. 11 months ago, 3.5% unemployment, today 3.5%. So the economy, it's fighting the Fed. And that's why I have zero belief that the Fed's going to stop. There's 4 Fed meetings in the first half of the year. There's Jan, there's March, there's May, and there's June. I think we get quarter point, and quarter point in all 4 of those. I don't think the Fed stops after 1 or 2. I think that's just Wall Street being Wall Street. They have been ridiculously bullish since the first day, and they've been ridiculously wrong since the first day. The Fed has actually done exactly what they said a year ago. They've been the only party that's been consistent in this whole process. They said, we're going to need to raise rates a lot. Their dot plots have been consistent. Everyone else just assumed the best, and none of those things have happened. And now, why are people continuing to assume the best? I think rates go from 4.25, that's the lower bound of the Fed funds rate today, to 5.25 by June. And then the Fed holds, because it takes a long time for inflation to come down from their, wherever it is today, 5.5%, 6%, to 2. And the Fed wants it down almost to 2% before they start cutting interest rates. Now, I want to point this out, and I know you have a separate question about this. We don't need the Federal Reserve to cut interest rates for mortgage rates to go down. There's never been a requirement to do that. The spreads compress when the banks start feeling better. The spreads are ridiculous right now. I don't know if Ken's seen them before. In my career, I've never seen the spreads being this wide. The spreads will compress when the banks feel comfortable. And they'll feel comfortable when the Fed stops, not when the Fed goes down. So I think we get some relief in the second half of the year from the high mortgage rates. I think the Fed's set on its ways.
Right. Thanks, Neal. That's a really good point. So the question, we're going to take questions here from our live audience in a little bit. So there's a chat box. There's also a Q&A box. So if you have a question, go ahead and put your question in there. We've got some more questions for our panelists here. So the question, if I'm an investor and I've got, a pile of cash in my bank account, and it's, I'm really wondering what I should be doing. A lot of people are holding cash because they're afraid, they don't know what to do, or maybe I should invest. What should I do? Really, the question is, buy more, hold what you have, or sell. And so we want to kind of go around and just get kind of each panelist's opinions on maybe what you're doing and kind of what you suggest investors. Obviously, not giving specific advice, but just which of those 3 look most appealing to you? Let's start with Ken.
Well, I don't like to pay tax. So, I think a lot of people have a capital gain strategy. So they buy something, they sell it for more, then they have to do it again. At some point, the music stops. So for me, in my 20-year history, I have properties I've owned 15, 16 years. We're still getting full depreciation on. Obviously, they've tripled, quadrupled in price, whatever. I think last I looked, we were right around $2 billion in assets, but I didn't pay that. It's the market has done that for me. I've refinanced stuff 2, 3, 4 times. So, if you can find something today that's cash flowing at 6, 7, I've done that. The price has to come down, and then what you have is an asset that cash flows at 6 or 7. And if rates come down again, like Neal said, and I do agree, at some point they're going to have to, when they go to 5, they go to 4. Now what you've done is you're scooping your equity back and you're actually lowering your payment. So if you go from 6, let's say today, and you can refinance at 4.5 or 4 at some point 2 years from now, let's say, you're going to be golden. I went through this. And so those are all assets we kept. I'm not a big net seller. I have obviously massive capital gain issues and depreciation recapture and all that kind of stuff. So I've always been a passive income guy. In my early career, I had to do it just to put milk, just to buy milk, right? So, but now, since then, we're just long-term holders. We love the depreciation, cost segregation, and the bonus depreciation, all that stuff that you get for providing housing. The government, incentivizes you. So we're in for the long haul. What saved my butt in 5, 6, 7, 8, let's say, was cash flow, period. I bought stuff and the values were compromised through little higher cap rates or whatever, but it didn't matter because I was cash flowing. So I think people forget, they lump real estate all in one big bucket. Single family does not act the same as multifamily. So it's actually countercyclical. If people can't afford a home and their mortgage payment went from 3 to 6, let's say it's $1,000 on a $450,000 mortgage, it pushes them into rentals. It's good for multifamily. When people are working from home and the leases renew in office buildings, that's not good for office. So, that's a lag too. That's coming. So I think you're going to have problems in retail. You're going to have problems in office. Multifamily is going to be really good, in my opinion. Over the long haul, single family is going to take a little bit of a hit, but we don't like to sell, Bronson, as you know. We like to acquire and just hold.
Yeah, absolutely. So you guys will do the infinite returns. That's your thing, right? To continue to hold and just continue to pull money out, which is awesome. Mark, let's talk. What would you say to investors?
Couple of things as far as the buy, sell, hold. To Ken's point, if you can buy in cash flow based on the rates and bump it up a little bit because there'll be some hikes potentially this year, then buy. I mean, people are like, well, rates are high. It's like, the rate could be 50%. It doesn't matter to me. If the deal still cash flows and you can make it based on a 50% interest rate, then buy. So it shouldn't be a discouragement. To Ken's point, which I love, is like, okay, at some point we know they're going to go back down. You hold a long time hold strategies like Ken, they come back down, then you're just pulling equity out on a refi or things like that. I think in some cases, people that are in deals, if they are kind of in trouble with either the rate cap not in place, maybe they don't have money for CapEx and things like that, the distressed deals, then I think if they can sell at a break even, I think they should sell. I just do. And there's other ones that I think if you have a strategy and a plan, like we're going to get to a point, even with the high rates, that we can start breaking even. We're not there yet, and you can survive. And maybe you have to put some money in there to do it. I would say, hold those because eventually, real estate will go up. I think as far as an investor, the smartest thing to do is what Neal already brought up. I mean, these funds that people are doing where, people need money. If you put yourself in a position, it's not going to be a question of where somebody comes in putting money in. 99.9%, they're putting themselves right after the lender and before every single investor you have in your deal. That's a smart way of doing it. So their position is pretty good, unless for some reason the lender came and foreclosed on a property, which would put you in a bad spot. But let's assume you're fine with the lender. If I come into a deal that you're in, Bronson, and you have a bunch of investors in there, and Ken, Neal, and I put a little pool together, we're like, hey, we're going to give you, $2 million, Bronson. And by the way, we have priority over every one of your investors. And this is where we sit, and you do a refi, we get paid first, the interest rate sky high. The protection there for an investor is really good. The risk is really low, and you would say risk adjusted, return. Well, these are going to be disproportionate returns in my mind, because people are going to charge really, really high interest on these deals that in some cases are pretty low risk because you're positioned there. So that's probably one of the best things in my mind, if you can get into something like that where you put yourself above other investors and you want to get, okay, by the way, I'm going to take part of the GP. In case the deal does perform, I'm coming in with money. I trump all your investors, and I'm going to get a part of your GP spot for doing this because of the hassle of kind of turning this property around. So
And Bronson,
we're going to see lots of
that
opportunities.
kind that I did, the way I wrote it, I'm coming in as a convertible note. So I'm basically coming in as a note, And I have the option. So I'm basically making 8% as a lender. So obviously I'm above all of the equity. The property is not cash flowing. But at any point in the next 3 years, I have the option of converting myself to pref equity.
Right.
And the operator doesn't have the option to prevent me. Market turns around, I convert. Market doesn't come around, I get 8%. I'm a lender. I'm not.
That's exactly right. Now you know, in Neal's case, he does sit, you know, right behind the senior debt, like the real lender, but that's about as safe as you're going to get unless you're a bank. That you can't get any better position.
So just
they accepted the deal. I mean, I just felt like they had no choice.
Right. So just so I understand, to break this down for investors. So this is like you have an investor pool that you basically syndicated a debt fund that goes into a troubled asset to an operator, and you get in a preferred position where you have convertibility into preferred return or preferred equity if you want, but you are a debt position and you can convert it if you want.
Yep, whenever I want. And what's interesting is I hate the word distressed, and I think Ken would agree with me on this. This is a debt distressed but highly overperforming asset.
Correct.
There's nothing wrong with the property. I mean, I would own this property any day, right? It's overperforming beyond its pro forma. It doesn't have a rate cap.
Right. It's a timing thing. Exactly. I use the same thing. Distress to me is like, hey, you know, we're coming in and it's vacant. We're doing all this stuff. So I totally agree with you. It's a timing thing, and it's really one issue related to the property, and it's related to the rates going sky high without a rate cap. Other than that, like you said, a lot of these properties, if you took it back to the original pro forma, they would all be, not all of them, a lot of these would be performing assets.
Yeah. And one other thing I want to add, because I actually disagree with Ken and Mark on this. So, you know, in terms of great time to sell, horrible time. Don't sell anything. Like, just makes 0 sense. You're basically paying blood money to the Federal Reserve if you sell anything right now. Sell nothing. Decent time to hold if you have a decent rate cap. But I don't agree with Mark and Ken. I think this is not a good time.
I would say this, and I'll tell you why. There are people right now that are going to foreclosure with a lender. You better sell your property, or you are done as a syndicator in this industry. So if you don't want to sell and the lender takes your property, you might as well pull up shop because you're done.
Completely agree. I think if you have to sell, right? I think that in those cases, sell. But on the buying side is where I disagree. I think we're in agreement on the selling side. Whatever you have to do to, return your investors' capital, do it.
Right.
I think this is not a good time to buy. I think that the market can only worsen. The economy is so strong that the Fed will have no choice but to at least go up 1 basis point, probably 1.5. There is a breaking point here that is coming. And I think that all of us are beginning to see signs of that distress. Some are seeing more, like Mark's seeing more than others, simply because Mark's network is bigger than mine. I mean, he's got more connections than I have. So he's seeing more of this stuff. I think it worsens in the coming 6 months. To me, I still feel like if it can cash flow, I should buy. I'm sorry, I'm not seeing anything that works. I'm just out of the market because I'm forced of the market at all. It's right.
And that's why Ken, I think, said if you can underwrite the deal, you can cash flow. No one said you could, but if you can, I think you should buy.
I think to me, the only thing that's working at the moment is coming into other people's deals where there's nothing wrong with the deal except for the debt payment. That's the only play I've got right now. Otherwise, I'm going to wait for 6 months because I do think that this will correct. I think that expectations correct every month, and they correct in the favor of buyers every month.
Right.
And I think this is why, too, as an investor, I think it's important to look at that you're an investor first, right? You invest in different assets, and maybe multifamily, there are deals, but maybe, it's not the right time. It's some people's opinion. I think we're doing a car wash deal. We've got our ATM fund. We got other things we're doing that we're finding are working well, but there are other things, but I'm still a multifamily guy, right? So there's things we're always looking for multifamily deals. We are getting some questions coming in. I want to dedicate some time to questions. I know we could I feel like I could have you guys all day and I'm just learning a ton, talking and sharing and everything.
All night for you, right? All night for you. It's like,
Well, it's already, it's almost 2 a.m. here and I'm amped up, man. So it's a question coming in about new construction costs going up. They've been hot. I think lately, I've heard they've been coming down with supplies a little bit, some of the supply chain stuff. Ken, can you talk to that a little bit? How is construction costs? How do you see that looking the next, 6, 12 months here?
It's definitely gotten better. A lot of these things are commodity, like obviously lumber's a commodity. So, and that's the one that everybody kind of points to. Oh, lumber's down, so everything's down. That's not exactly true. We're getting clobbered on concrete. We're getting clobbered on OSB. We're getting clobbered on appliances. Our appliance package, stainless package is $2,400 a unit now. Things are tough to get. Midstream, we maybe can't get 400 microwaves, so we're still seeing a little bit, but it's definitely significantly better than what we had. So I do see it settling down quite a bit on the, like I said, we have 6 deals, 2 are under construction, 4 in pre-development. And, so we're very active, at least in Arizona at the moment.
Yeah, I just want to add, I'm not seeing labor come down. It's very disappointing. I'm seeing, materials come down. And a lot of that has just happened in the last 2 or 3 months. So I have a lot more, unfortunately, than 6 construction deals. We've got about 19 of them. 6 of them, I just put them on hold. I had equity. I went back to my investors. I said, look, I own the land. I have no debt. It makes absolutely no sense to do anything. They're ready to go. They're shovel ready. I'm just putting them on ice. I mean, it makes just no sense. Why don't I just wait for 6 or 7 months? I'm just going to have this outrageous, crazy 10 or 11% debt payment. So anything that's not far along on the construction side, I'm just putting on ice. I'm still waiting for the labor cost to come down. But the way builders work in the US, until the day that they have jobs, they behave one way. And then all of a sudden, their last job finishes, and then they're like begging you for stuff. That hasn't happened yet, at least not. I build in the Texas, Arizona markets. Labor hasn't come down. So, new construction, very difficult at the moment.
I will just say one thing, like on the deal that I mentioned on, we have one on, we're going to be opening soon. We projected 60 to be all in. And we thought it was going to be worth around the low 80s, at completion. And we just got an appraisal at 112. So, that's the other side of it, so to Neal's point, there's some short-term cash needs, which we had to cover, some cost overruns and things like that, and even interest rate overruns. But when we go, I don't know if 112 is going to be 112, at the end of the year, but whatever. So the point is we're going to get something, and it's significantly above what we started at, almost double. And so there's enough there, even if we're 60% loan to value, we're way in the money. So I think, so we'll get that back. So we're looking at these as short-term loans, kind of like Neal. That's all we look at this. And so that's how we're treating construction.
I think
one other question that comes up here. Oh, go ahead. Sorry.
I think Ken's doing some of that. I can tell that he's doing it. I stopped investing in, I'm one of those people that'll give a lot of my money to passive syndicators that are doing other things that I don't do, ATMs, car washes, you name it. I mean, bunch of multifamily things. And I used to invest a great deal of money each year because I felt like I was part of their success, even though I was just a passive guy, right? I had no control. I just felt like I was learning through all of the stuff that they were doing. I haven't made an investment in 8 months. I'm just holding cash, and all of my cash is sitting in a bank account, Comerica bank account that pays me 4.1% interest. I'm happy about that. I mean, it's $130,000 a year of interest, but it's sitting there, and that's why I'm not losing sleep. It's money that I've made in this industry. And now if something bad happens, I need to use short-term loans and basically use my money. I think that's the mindset. If you as a syndicator have made money, then you need to have that mindset. You can't only look at the good side.
Yeah. One more question. I think we're getting a couple more questions coming in here. So let's talk real briefly, fixed debt versus bridge debt or shorter term debt. I know it's challenging to, there's loan to value stuff that's changed, especially for fixed rate. You got prepay stuff. Is fixed rate even an option right now to get? Is it hard? Is it just very difficult? Or what is the fixed rate situation versus bridge?
I wouldn't distinguish between fixed rate and bridge. There is fixed rate bridge. So whether you're Fannie, Freddie, Bridge, they all have fixed rate options. Is it hard to get? No. If you want to pay a high enough interest rate, you can get all day long.
Is the
Yeah.
spread, I guess I was going to ask about the spread. What are you seeing as far as the spread between the two? And I guess, yeah, maybe a better way to see variable bridge versus more fixed rate or agency, I guess agency debt.
Yeah,
we're
the
not even
fixed rate-
considering it. Yeah,
Yeah.
there's too much risk on variable, and the caps are expensive. So we took that off the table months ago.
Yeah, well, with a fixed, so even with bridge, just to clarify, with a fixed bridge, so let's say you get a 5-year, there's no rate cap on it because it's fixed. So that's one. The reason someone even can consider doing it is if they're doing a big, huge CapEx project, you're not going to get the loan typically on a Fannie or Freddie, any CapEx, and you have $20,000 a door CapEx, which I'm done with a lot of those deals now anyways. But if you're doing those type of deals, you're probably going to want to do bridge because you're going to get 100% of the CapEx in your loan on a bridge. So I guess I was just distinguishing that, it's not Fannie, Freddie, fixed, and bridge is everything else. Bridge has every option you possibly could think of. Be careful. Don't get into like something like a 1-year bridge, 2-year bridge, not good. But some are 5, like 3-1-1. So it's 5 years, which, is a runway. But if you have a choice between the two, I would go more on a agency, Fannie, Freddie all day long, unless you just, if you have $10 million in CapEx and Fannie and Freddie says I'm going to give you 0, you might look at
it doesn't work. This will be our last question here. This is basically Lee is asking about, you don't have the track record that everybody has. So how do I find distressed deals in the next 6 months? Like, what are some ways that you'd suggest somebody? Obviously, all of us have networks and these deals may be coming to us, but what would you suggest for somebody that's newer? Like, how would you be networking and trying to find some of these deals that could be available in the next 6 months?
It's easy. I mean, I'm at the Raise Fest that you see that. Go to a conference, tell people I have the ability to raise equity for a deal that's a good deal, but is negatively cash flowing. Someone needs to recapitalize it. I want to talk to them. Could you please let them know? That's all really you have to do, because the people that need to recap a deal, that's the term, the technical term that we use in the trade. The deal has to be recapitalized. If you go out there, there's not a lot of people saying that, which by the way, I'm surprised by the syndication industry. I thought by now the vultures would be all over us, and I'm not seeing enough guys walking around with cards. I don't know if Ken's seen them, but it's such a great opportunity right now because so many of these properties actually make money if the interest rates come down, right? There's no distress. So, I mean, you should be out there saying, make a card. I mean, cards are $25 for 500 cards. Make a card that says, if you have a property that needs to be recapitalized and it's a good property, call me at this number. It's really simple. It's not hard at all.
Yeah. Awesome, guys. Well, I wanted to be sensitive of everybody's time. Really appreciate each of you coming on. This has been a blast talking with you guys. I think there were some great discussions, some great questions, just looking at the chat, and there's lots of awesome discussion there. I wanted to say to everybody joining us, thank you for being here. The best investment I think you can make really is in your own education. So things like this are phenomenal. So I encourage you to follow each of these guys. They have a lot of content they put out, doing stuff on YouTube and podcasts and different types of things. If you like this content, we also put this out on iTunes. I put the link in the show. It's called The Mailbox Money Show. I interviewed all of these all of these guests in the last 12 months and Neal and Ken recently. So check that out, and also be sure to give us a 5-star review. Like I mentioned, our investment club, we have deals coming available, a car wash deal that's coming up. We have our ATM fund. We have some other stuff in multifamily we're doing. Just wanted to give you guys each a chance if people want to reach out or something you're working on, just maybe a short, 20-second thing of what you're doing, how people can connect with you. We'll start with Neal.
I'll Ken go first, please.
Okay, well, Ken go first. Ken's sitting there waiting.
Well, no worries. So obviously you can get us at kenmcElroy.com. We got all kinds of stuff there. Just trying to, I think Neal brought it up. Going to these conferences is going to be very, very important this year. For the people who will tell the truth, and I think there is a fair amount of people that are there looking for recapitalization. I think that's going to be the wave this year, this whole year, whether they, say it or not. So I would continue to do that. We continue to pump out whatever we can on YouTube to try to educate and help people. So I don't want any investors, I don't want any LPs to lose money. That's one of my biggest things. And there's a lot of people that aren't staying educated on some of the stuff and listening to stuff like this, because you can make changes and you can make moves now to cover all of this in 2023, 2024.
Well, my connection is really simple. I'm the only Neal Bawa on the World Wide Web. As long as you get my spelling down, just type in Neal Bawa, hit enter, you will see a bunch of stuff. And that's probably the best way for us to get connected.
Thanks, Neal.
For
Mark.
me, it's Mark, M-A-R-K @thinkmultifamily.com. Just shoot me over an email.
Awesome. Well, guys, thank you again so much. This has been great. The 2023 Multifamily Outlook event. This will be sent out via email. It will also be available on YouTube probably tomorrow. So please feel free to share this, give it a thumbs up, and looking forward to a great 2023 for everyone. We do have an inflation event coming up on February 16th. We're going to talk about what's happening with inflation and high interest rates. So we kind of do multifamily and then we talk about inflation. So thank you for joining the Bronson Equity Monthly events. We look forward to seeing everybody again soon. Thank you to all our panelists and for all our guests today.
Guys, enjoy. Cheers.
Take care.
Hey guys.
Thanks,
Good night.
guys.